Hey everyone, it's Julie here with TipRanks. Today we're taking a look at two trending stocks that have been dipping in price. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at two trending stocks. We're talking about some of the best rated stocks in the last 30 days. And while these stocks do come in with a strong buy consensus from Wall Street, they are in the red over the last few months. So we're going to take a look at these companies, what's been going on with them lately, and what has Wall Street feeling so bullish about their turnaround. We found these stocks over on the TipRanks Trending Stocks page. This is found under the Research Tools menu, and you can find a collection of the best, worst, and most rated stocks over the last 30 days, 7 days, or 72 hours. I narrowed in on the best rated over the last 30 days and sorted by analyst price target when I noticed a couple rated a strong buy that have been dipping in price. You can check out the trending stocks for yourself over on the TipRanks website or right on the TipRanks mobile app, which you can download using the links down below. Just before we get into these stocks, this is a reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Now let's dive right into these two trending stocks. First up today is Affirm Holdings. They trade under the ticker AFRM, currently priced just shy of $48 per share. Now they are in the green overall in the past year, but in more recent months the stock has fallen and is down 25% in the last 3 months. Affirm Holdings is a fintech company operating in the digital payment sector. They provide consumers with a transparent and flexible payment option through their Buy Now, Pay Later or BNPL solutions. The company's core product allows customers to split purchases into installment payments over time, offering an alternative to traditional credit cards. They partner with various merchants to integrate their services directly into the checkout process. Their stock did fall following their latest quarterly report near the start of May, despite an earnings beat. Affirm provided a more cautious than expected future outlook. They reported Q1 earnings per share of 1 cent, which was 2 cents higher than analysts were anticipating, and revenue was in line with analysts' expectations. They did see strong growth in their gross merchandise volume and some successful 0% APR promotions. But looking forward, the company is anticipating revenue between $815 to $845 million, and the midpoint fell below the consensus. In more positive news, just last week they did announce a new deal with Costco. This multi-year partnership will allow shoppers to use Affirm's Buy Now, Pay Later option when shopping on Costco.com. And we recently heard from a 5-star analyst at William Blair. They reiterated their buy rating, saying that Affirm was well-positioned for long-term growth despite some short-term challenges. They said they had a strong position in the Buy Now, Pay Later market. Despite a recent rally, Affirm stock is still significantly below its 52-week high, presenting a potential buying opportunity. And they believe that Affirm is well positioned for long-term growth, focused on increasing market share and unit profitability, even if it means sacrificing some short-term financial gains. With 21 current analyst ratings, the Affirm stock does come in as a strong buy with 16 buys and 5 holds. The average price target of $66 would imply an upside potential of 39% from current prices. And looking at those ratings down below, we do have several analysts increasing their price target as well as a couple lowering it, but all with double-digit upside potential ranging from 17% up to nearly 80%. Our second trending stock that has been dipping in price is DraftKings. They trade under the ticker DKNG, currently priced just shy of $36 per share. They are in the red overall this past year, down 14%, and in the last 3 months, they've fallen 18% from highs back in February. DraftKings is a well-known name in the online sports betting and entertainment world. They offer 3 main services, including their daily fantasy sports, where users create fantasy sports teams by selecting real-life athletes. They have their sports betting, which is available in 22 U.S. states, and their online casino, which offers over 400 casino games. Weighing on the DraftKings stock recently was their revised revenue guidance for 2025. In their latest quarter, their fiscal 2025 revenue guidance was revised down to $6.2 to $6.4 billion and adjusted EBITDA guidance to $800 to $900 million. On top of that, they also saw an increased tax rate in Maryland and Jack Pocket's shutdown in Texas and New Mexico added to the headwinds. But there were certainly highlights to the quarter as well. Earnings per share came in ahead of expectations, and revenue slightly missed estimates but did see some solid growth. They reported a loss per share of 7 cents, which was 1 cent better than expectations, while revenue came in at $1.41 billion, and that missed by just $20 million and grew 20% year over year. They also saw their sportsbook handle increase 15% year over year and increased operational efficiency. Just last week, we did hear from an analyst at Morgan Stanley who reiterated their buy rating. They highlighted DraftKings' strong growth potential and strategic positioning in the market. They said the management's confidence in the long-term growth of the online sports betting industry, despite concerns about decelerating handle growth, is a key factor. They attribute the slower growth to a shift in bet types and previous heavy promotions, but expect positive growth moving forward. And it seems all of the other analysts covering DraftKings agrees. With 24 current ratings, the stock comes in as a unanimous strong buy. And their average price target of nearly $55 implies a huge upside potential of about 53% from current prices. We do have several analysts slightly lowering those price targets, but once again, still lots of upside to be seen. Looking at the most recent ratings, those price targets range from an upside of 25% all the way up to 67%. So that is a quick look at two trending stocks that have received a lot of love from Wall Street lately, but are in the red in recent months. Let me know your thoughts if these are a good buy the dip opportunity or what other stocks you've had your eye on lately. I always appreciate hearing from you guys. Of course, please keep in mind these videos are never a suggestion to buy or sell any specific stock, so make sure you always do your own research and due diligence. Thank you guys so much for watching. Have an awesome day, and I'll see you back here next time.